Your view right now on the market, which many saying in South Africa has been in a bull run, in light of the fact that we're seeing kind of, dramas in Europe continuing, uncertainty over the direction of the US economy, and of course, China, a big question mark right now.
Yes, but it is undoubtedly a cyclical bull market that we've experienced. And I think what our clients are wrestling with is, you're talking about the international news flow that has been predominantly negative. But even if you look at South Africa as well, the news flow has not been great from a macro perspective. We had all the events with the strikes. If you go back 9 months ago, most people expect the economy to grow at a rate of about 3%. Probably we'll only see growth of 2.5%. And there's increasing signs that the consumer is under pressure. Yet the market has recorded a new high. And the only way that I can explain it is that it's perhaps the alternatives to equities are simply not giving investors a long-term viable option to grow their wealth over time.
So it's basically the fact that interest rates are so low right now, and direct negative correlation between that and of course equity market performance.
Exactly right, and I think that is the first point. And then we always talk about the market, and it's a general concept, but within the market you can still find companies that can still generate double-digit returns and are arguably not priced at very expensive levels. And investors get comfortable with those kind of forecasts and prospects, and they're quite happy to accumulate those assets to generate wealth over the longer term.
So talk to us about some of those companies, because I mean, talking about the likes of ShopRite and everything, certainly not expensive if you're listening to what local investors are saying. So which are the companies that are generating double-digit growth and are priced attractively right now?
Well, if you look at ShopRite, if you look at the actual price earnings multiple, historic one, I've got to say it's about 29 times. So from a price earnings multiple perspective, you can't argue that it is cheap. It trades on a price to book of about 7 times, and it is priced at 1 times to sale. So it's an absolutely phenomenal company, and we don't dispute that. To our liking, it just feels a bit on the expensive side, with the margins being just over 5%. Compare that with Pick n Pay margin of 1%. So you say to yourself, from this base, how much growth is left? And yet they've grown their revenue line by 15%, as you just indicated. But I think there are other companies. British American Tobacco is one which we still think can grow their earnings high single digits, early double-digit numbers. Even the banks, I think the numbers of Nedbank, the banks can probably grow their earnings by about 15% or so. So I think within the industrial space, there are quite a few companies that can generate double-digit earnings growth, and then it's the question, how much do you pay for that earnings, and how sustainable is that earnings into the future?
When we're talking about South Africa within the cycle, you're certainly looking at indicators right now showing that consumers are under pressure. ShopRite talks about it, but they kind of with the PR spin saying that they're gaining market share as a result of it, and then of course Nedbank saying that they're very cautious right now. Not the first company that said very cautious about the outlook. So what does that mean about investing right now in cyclical versus defensive stocks?
Look, the defensive stocks are those stocks that you've just mentioned, because that is generally the consumer stocks where people, if you look at a food retailer, that in my book is a defensive stock. But even they, as you say, when they talk about it, they talk about the situation that is really deteriorating to some extent. But if you look at the cyclical shares, you don't have the same kind of certainty in terms of the earnings stream. However, if you look at the multiples or the valuations of those shares, certainly for the contrarian investors and for the value investors, you can clearly see that they appear to be less expensive, or certainly they appear to be on the cheap side. The problem though is, if you do an analysis over the last 3 years, then you will see there's a very, very good correlation between what we call high beta stocks and economic news flow. Now, high beta stocks are stocks that are very sensitive to economic activity. So whenever the market really moved up significantly on good economic news, those would be the high beta stocks, which are the cyclicals. But the opposite is also true. So if you think that the macro environment can still be quite volatile for the next year or 2, 3, then you should expect a lot of volatility from those shares. At some point, they will become cheap.
And of course, you're talking about resources, I assume here.
I'm talking about resources in particular, and that is what makes it so difficult. And when you include those stocks in your portfolio, your clients must understand that you buy the value, but we're not necessarily going to realize that value in the shorter term. So
Certainly
you've got to have a
not in the
longer
year.
term. You've got to have a slightly longer term view when you start to include those stocks. And certainly when you want to take those stocks to an overweight position in your portfolio.
And don't just judge a performance on a quarterly basis. Let's look at offshore exposure and how much is appropriate right now. Where are you investing? Where are you recommending offshore exposure?
Okay. Look, we don't do the geographical asset allocation globally, but we will say, okay, take your money outside. I mean, I can venture a view on that, but when investment relation issues the only reason why you take your money outside, we would say to our clients, you should take about 35% of your assets offshore. Of course, if you're in a pension fund, you can only take 25% offshore. There's a big debate always, is it emerging market, developed markets? And quite frankly, I think that the boundaries have got blurred. You can buy a stock being listed in the US economy, but they generate almost half of their profits outside the US economy.
So give us some companies that really stand out right now, because of course we love to get the details.
Just like in South Africa, I think you probably find a lot of comfort in some of the world's blue chip names. So you can look at Unilever, that I think came out with very good results. You can certainly include that in your portfolio. We like Diageo, that can still grow their performance. If you like the theme of the global consumer, and particularly in the emerging world, you can buy Richemont in our own market. You can probably buy LVMH in the global markets. And then, Microsoft came with their results last week, and I think that is the one share that is certainly trading on very undemanding multiples. And hopefully, if Windows 8 is a success, that might just provide the catalyst to create a re-rating in that particular share.
Certainly is seeming like they might be closing in on the gap slightly.